But Vipul Prasad from Magadh Capital is with us to talk about what he's making of trade. Vipul, let's first start with what interests you in the market right now. If there are any individual stocks or sectors that you at Magadh Capital are extremely bullish on and you believe that this market volatility should be used as an opportunity to buy those names.
Good afternoon. Thanks for having me on the show. Yeah, there are some sectors which are looking good, but again, not for basket buying. It'll be more like selective stocks in those sectors. So some of the names that come to my mind immediately are like something like a consumer staples or some of the metal names or even a consumer discretionary. So the key here is, for example, let me start with consumer staples. So yes, the valuations are on the higher side, but one is paying for quality, and even here one can be selective. One doesn't need to go at the higher end of the valuation range because the story here is very clearly visible that rural revival is definitely in the play, and that is impacting their revenue growth positively, obviously, and also the negative impact that they had felt on their top lines because of the twin shocks of demonetization and GST. They are slowly waning away. It's not that they went away just in one go. So that positive impact on the year-on-year growth will be visible for some more time. And some of these names are also very closely controlling their cost structures. In fact, premiumization is also working for some of these names in terms of their margin enhancement. And keeping into account all this, reasonable valuations are still available for some of these names. So I would definitely be looking at some names in this sector. Looking at consumer discretionary, I am talking specifically about something like auto sector or consumer durables like an AC companies. So in a case of the auto sector, right now we seem to be in a cyclical lull, and the impact of high cost of funding has been felt very clearly, and also the impact on high cost of acquisition, as in like high cost of buying because of changes in insurance norms, has also taken a toll. And to some extent one can also say that till 2.5 months ago, the rate of increase in fuel prices also impact the propensity to purchase auto names. From here, some of the leaders like say Maruti Suzuki or Eicher, some of them can do quite well in volume growth, especially given the fact they have strong brand connect, they have very well entrenched distribution systems, and also given the fact that they have long-term commitments to the Indian market. So that I would say it's a matter of 2-3 quarters more before their volume growth starts reviving. And even on the margin front, it looks very clear that the price hikes that they have taken should suffice for the cost inflation that has been felt so far, and also some stability to Indian rupee. Volatility should recede. So margins also should be protected. And of course, given the way these stocks have behaved in the last 1 odd year, the valuations also have become more reasonable. So they also look interesting. And one more sector, if I were to add here, would be metal. But again, as I said, these are not, there is no case for basket buying again in this one also. So what I am looking at is that companies that are done with their long capital expenditure phase and who are moving into a phase where they are going to monetize the capital expenditure, the investment that they've done in the last 5-6 years, they look interesting because in the next 2-3 years, they'll see sustainable improvement and sizable improvement in their cost efficiencies, in their product mix, or even in their volume. I mean, volume growth will be quite sizable as well. So these kind of stocks look quite interesting because their return ratios will improve sustainably. Another model that I'm looking at in this space is that cost leadership, because of such structural reasons, that also going to pay quite well, especially if it is accompanied by strong balance sheet. So some of these names are available for very reasonable value, in fact quite inexpensive valuations. So worth looking at those names also.
Right. Kunal, I want to get you in on this juncture. You know, Vipul just talked about as to how there are opportunities within metals which one can look at. Where is it that you're getting buy signals when it comes to metals as a segment?
Well, I think, Aisha, none of them, frankly, because most of these metal stocks, they are either going through a I would call it as a volatile consolidation, not a normal or a general consolidation. They're trading in a range, stocks like Hindalco, I would say even Tata Steel to that extent. I think they're trading in a big broad range, and that volatility of the stocks trying to hit both the bands, I think the upper and the lower in the band, and that too more frequently, is the reason why I believe that these stocks are still in a big volatile consolidation. I think even names like JSW Steel, which is now I think on a second successive consecutive month, sort of a correction, I think that stock has also broken its 200 moving average. So that strength which JSW Steel had, I think in the entire metal pack, I think that strength has also faded off. And most of these metal stocks like Tata Steel, Hindalco, Jindal Steel also in the tier 2 category, I think these stocks are trading below their key averages. I think that's one of the reasons why you're not seeing any pickup of momentum. So when the markets had a good phase, I think just a couple of weeks back, metal stocks failed to rally. I think most of the sectors rallied. IT had a phase of rally, but metal failed to rally. So I really doubt that when the markets are going to correct, that these sectors or these stocks could probably lift off first.
Vipul, when we talk about the markets, what do you expect the flows to be like in next year? You think DII flows, what's happening in the mutual fund, that will be one of the key triggers for market valuations?
See, liquidity does play a big role here, but more importantly, I'll also look at the fundamental drivers. Some of them may be temporary in nature, some of them may not last for long, but still the way I'm looking at the market for 2019, first half I expect it to be fairly volatile, and I'll not be surprised if the first half ends with flattish kind of returns or even slightly lower than where we start the year. I'm more positive about the second half of calendar 19. In fact, I would expect maybe high single digit returns from the market. Now, what are the factors that are driving volatility in my view in the first half of calendar 19? So first thing obviously is the specter of a weakening of the global economy, especially driven by the whatever the developments that we have seen in the US recently. Then also about how the election results are going to pan out. So although let's face it, eventually election results do not matter much for the markets, but as we approach the elections, especially in the backdrop of the recent assembly elections, when we have had some concerns whether the current government will be re-elected or not, so then we are thinking about some sort of coalition government coming in place. Then some sort of pressure does come in. People do get concerned. So in that backdrop, I would say that first half looks volatile. And also the NBFC pressure that we saw in terms of cost and availability of funding, that also will play as a headwind. So that's the reason first half doesn't look too great. Second half, what is going to change here? Firstly, the US Fed rate high cycle will peak out most probably by the middle of calendar 19 or maybe late 2019. Also, the banking system will be in a much better shape to revive lending. So that'll be a big thing, because by the end of late 2019, we should also be in a situation wherein the systemic capacity utilization should move into the mid to late 70s, and that is when most of the corporates start their next phase of capex, and for that we'll need the banking system to be prepared. So hopefully that should be there, because more and more instances of NPA resolution via the insolvency and bankruptcy code should be visible in the next starting 2-3 quarters definitely. And one more thing that I would want to highlight, that the favorable impact of actual GST implementation and then stabilization is going to take another 2-3 quarters. So as that also starts getting visible, definitely corporate earnings should also improve, because that is one thing that all of us have been kind of negatively surprised over the last 4 or 5 years. Every year we start with a decent number in the beginning, and by the second or third quarter we start cutting big time in terms of our expectations on earnings. So I think as earnings expectation really start moving up, in fact earnings expectation are matched by real earnings as they are delivered by the companies starting third quarter of say fiscal 20, we should see some improvement there. So yeah, that's the way I'm looking at it for 2019 in terms of market performance.
Well, the way things are panning out, you know, from government perspective, that they are ensuring that fiscal deficit doesn't rise, and that's the reason they have delayed the decision related to decrease in GST rate in cement as well as the other commodity or real estate. We are also seeing that, you know, talks with RBI going on for higher dividend payout. It seems that government is on track of doing more capital expenditure going forward, and probably that's the reason you are liking some of the selected names, as you're saying, in infra space. Now we all know that, you know, people end up suggesting L&T when it comes to infra or cap goods. I want to discuss with you how other names apart from L&T are shaping up, and what is your outlook going forward when it comes to some of the mid-cap names in infrastructure space?
Actually, I'm still a bit scared about that sector, because definitely highway sector has done quite well, as in like this government has done very well on award of those projects and delivery on those projects, and some of the names are doing have done quite well, some of these stocks. But I would still put them in two buckets. The first bucket is some of these names have done well, but their balance sheets are still stretched. The second one, where the second set of companies where the balance sheets are not stretched, but visibility is still limited. I mean, you still have a kind of order books which don't stretch much beyond 2 years or so. So, and then you start thinking as in like, what is the next leg? Then also for the entire sector, you still have concerns about, let's say, at least about some of the companies here. Corporate governance, generally the market is concerned. So I would rather play infrastructure by names like something in metal, for example, SAIL, or maybe even an Alco. So that's the way I'll play infrastructure story.
Right. You know, Vipul, just would like to highlight some stocks before I come to you. Just wanted to highlight Max India. They just announced the deal. The stock is now down 4%. The time when they announced the deal, it was on the positive side. So this is one stock that's going down 4%. SRF has extended on to losses when we last checked it. It's now down close to about 8%. And you have a whole host of large cap names also, which have gone off the day's lowest, off the day's highest point, or, you know, who were struggling, were flat, and now have suddenly given up. JSW Steel, for one, was down 3%, is now down 5%. Hero MotoCorp was down since morning. Motherson Sumi back to the levels of 160. IOC cement names are weak since morning. A light of Hindalco, BPCL, all of these names are not really looking that great in the session, especially in the last 45 minutes. You know, you have seen some extended sell-off into these names. Maybe a Bank of India is outperforming. A BHEL is doing decent, but BHEL in the afternoon session was up close to about 4%. It's now just up about 1% or so. So even that's a name which is going down, you know, more so ever right now. Vipul, you know, you just spoke about infra names, but what is your sense on BHEL, or probably, you know, heroes that were there about 8-10 years back? For 10 years, they've continuously gone down. Some of these companies are looking interesting, or go with the new age infra companies?
See, BHEL has gone down in line with the sustainable decline in their fortunes. So the business model itself has disrupted. I'll not call business model, but I'll say the prospects of the business. So there was not much change in the business model, and the prospect as in that, firstly, if you, of course, you talked about 10 years ago. So 10 years ago, yeah, BHEL looked like a champion, and it was a champion. But the problem emerged when more and more companies got excited by the prospects of power generation equipment, and more competition started coming in. then the bigger problem emerged that there is a limitation for how much of power capacity you want to set up. And now we have reached a situation where in the next 3-4 years, rightly or wrongly, we don't have too much in the pipeline. Pipeline is like capacities that are done 60-70%, they are still to come up. But beyond that, right now, no new project, not many new projects are even on the drawing board. So probably the next round of new power generation projects will start getting constructed beginning 2022 or 23. So again, that's a different debate wherein it's right or wrong in terms of power demand supply situation in the country. But taking all this into account, I think BHEL will struggle to run at a decent capacity utilization level, forget about growth. So that's why BHEL doesn't look too great. I mean, of course, one can argue that there'll be reasonable rebounds once in a while. It's fallen quite a lot. All those things are there. But beyond trading calls, one can take a fundamental long-term call on this stock. In fact, if one has to take a similar, but again, it's not exactly a similar thing. I'll rather look at something like Bharat Electronics Limited. It's more like defense, but it's very different set of dynamics that Bharat Electronics Limited is working on. So in the last 3-4 years, the capital expenditure has not gone up on defense. It's more like revenue expenditure. So, and these come in spurts. So next 3-4-5 years, these will go up substantially. Their order book is already quite large. I mean, almost I suspect 4.5 times of their revenues and going up quite well. Margins are well protected, although there was some scare some time back, and their valuations are quite reasonable. So I'll rather say BEL would be much better.
Okay, great to then have you on the show. Thank you so much for taking the time out and speaking with us today.